Hey everyone, welcome back to the deep dive. We've got a really fascinating topic to dig into today.
Yeah, this should be a good one.
Yeah, you guys have been sending in some really interesting articles, and it seems like everyone's really interested in this whole idea of accounts receivable factoring, especially for SaaS companies.
Definitely a hot topic.
Yeah, I mean, it makes sense when you think about the way SaaS businesses work, right? Always needing to fuel growth, but then waiting for those subscription payments to actually come in.
Yeah, that can be a real pain point.
So today we're going to cut through all the noise and really break down how factoring can be a powerful tool for SaaS companies to kind of manage that cash flow and keep things moving forward without, getting lost in the technical weeds.
Exactly, make it practical.
So you're a SaaS founder, right? You're building this amazing product, you're signing up new customers, but then you're also dealing with this constant juggling act, right? Of needing to invest in growth, but then also waiting for those payments to roll in.
It's like you're pouring water into a leaky bucket sometimes.
Right, exactly. And that's where this idea of accounts receivable factoring comes in. So in the simplest terms, it's basically selling your unpaid invoices to a third party, called a factor, to get cash right away.
Immediate cash. Yeah.
So it's like a way to sort of fast forward your revenue cycle without taking on debt, which is a big deal.
Huge.
Now, it's important to distinguish this from something called accounts receivable financing, which is similar.
Right.
But in that case, you're actually using your invoices as collateral for a loan.
That's the key difference.
Exactly. With factoring, you're actually selling those invoices outright.
The factor is essentially buying the right to collect on those invoices.
Okay, so let's paint a picture here. Imagine your SaaS company just delivered its awesome service, you sent out the invoices, and your terms are, let's say, net 90.
Oof, that's a long wait.
Yeah, 3 whole months before you see any of that money.
Yeah.
Now with factoring, you take those invoices, you submit them to the factor, and they go through this process of verification.
Due diligence?
Due diligence, right. They're checking if the invoices are legit, making sure your customers are good for it.
Credit worthiness is key.
And if everything looks good, they'll give you a big chunk of that invoice value up front.
Usually somewhere between 70 and 95%.
Wow, that's significant.
Yeah, and that speed can be a game changer, especially if you've got a time-sensitive opportunity.
Oh, absolutely.
Yeah.
I mean, think about if you need to, suddenly ramp up your marketing because you're seeing this surge in demand, or if you need to upgrade your infrastructure to handle a huge influx of new users.
Right. You can't always wait 90 days for those payments.
Exactly, yeah. So once they advance you that initial amount, the factor then takes over collecting the full payment from your customer.
Yeah, they handle all the follow-ups and everything.
And once they collect, they send you the rest, minus their fees, of course.
Right. So it's a multi-step process, but the real benefit is getting that cash much faster.
Okay, so who are the players in this game? We've got you, the SaaS company, providing the service and needing that cash flow. Then we've got the factor, the financial institution, who's buying those invoices at a discount.
And they bring a lot of expertise in managing collections, which is something a lot of SaaS companies may not have in-house.
Yeah, that's a good point.
It's a specialized skill.
And then, of course, you've got the customer who's ultimately paying for the service.
And the factor's experience can often lead to quicker payments overall, which benefits everyone involved.
Okay, so let's get into the nitty-gritty, the financials. One of the first things to understand is the advance rate.
Yeah.
This is that percentage of the invoice value you get up front.
Right. It could be 75%, could be 90%. It really depends.
It depends on things like how creditworthy your customers are and how many invoices you're factoring.
Volume plays a role, too.
And then you've got the factoring fees or the discount rate. This is essentially how the factor makes money.
Their cut.
It could be a flat percentage or it could be variable depending on how long it takes to collect.
Like a percentage per week or something.
Right. And these fees cover the factor's profit margin, their operating costs, the risk they're taking on, and their own financing costs.
It's crucial to get a clear picture of those fees up front so there are no surprises.
Yeah, transparency is key. Now, when we talk about risk, there's a big difference between recourse factoring and non-recourse factoring.
Big difference, yeah.
With recourse factoring, if your customer doesn't pay, you're on the hook.
You might have to buy back that unpaid invoice.
So because you're taking on more risk, the fees are usually lower, and you might get a slightly higher advance rate.
It's a trade-off.
With non-recourse factoring, the factor takes on that risk of non-payment.
So if the customer goes bankrupt, for example, the factor absorbs that loss.
Which gives you more peace of mind, but of course the fees are going to be higher.
You're paying for that security.
So you've got to weigh the cost versus the risk and figure out what makes sense for your business.
And the type of customers you have. If you work with large, stable companies, recourse might be fine. But if you're dealing with smaller businesses or startups, non-recourse could be a safer bet.
Makes sense. And then there's the issue of notification.
Right.
So with notification factoring, your customer is told that their invoice has been sold and they need to pay the factor directly.
That's the standard approach, usually.
But with non-notification factoring, everything's kept confidential.
Your customers keep paying you as usual, and then you forward the money to the factor.
So it maintains that seamless relationship with your customer, but it might come with some tighter requirements or slightly higher fees because of the extra steps involved.
Yeah, there's always a trade-off.
So you have to balance the desire for confidentiality with the potential costs and operational complexity.
And it can also impact your internal accounting processes, so that's something to consider as well.
Okay, so now let's shift gears a bit and really focus on why accounts receivable factoring is particularly interesting for SaaS companies, right? Because the SaaS model has some unique features that can make this a really attractive option.
Yeah, the subscription model has its pros and cons when it comes to cash flow.
Right.
You've got this predictable revenue stream over the long term, but in the short term, it can be a bit of a headache.
Because you're delivering the service continuously, but you're recognizing the revenue gradually, right?
Exactly. You're incurring all the costs of development, support, infrastructure up front, but the cash is coming in over time.
And then you add in the often massive cost of acquiring new customers.
Oh, yeah. CAC can be a real killer.
You're spending on marketing, on sales, on onboarding, and you're not seeing the return on that investment for a while.
It's like paying for a marathon runner's training, but only getting paid after they've run a bunch of races.
That's a great analogy. And then you have to factor in things like churn, right? Customers canceling their subscriptions, which can throw a wrench in your cash flow projections.
Definitely makes things less predictable.
Plus, many SaaS companies operate on annual renewal cycles, so you can get these peaks and valleys in your cash flow depending on when those renewals happen.
Not always a smooth ride.
And as you grow, you need to invest in your infrastructure, right? Servers, bandwidth, customer support, all that stuff, which requires upfront capital.
Essential, but expensive.
So with all these challenges specific to SaaS, let's see how accounts receivable factoring can be a potential solution.
Yeah, it can really address some of those pain points.
So the most obvious benefit is the instant boost to your cash flow and working capital.
Yeah, you're essentially turning future receivables into present-day cash.
Which bridges that gap between providing the service and getting paid, gives you more flexibility to manage your day-to-day operations.
And to jump on those growth opportunities that pop up unexpectedly.
Absolutely. You can reinvest that cash into marketing and sales to acquire more customers.
Or you can speed up product development, add new features, keep your platform competitive.
And of course, it ensures you can cover your basic operating expenses, salaries, vendors, all that.
Keeps the lights on.
Exactly. Now here's another key point. Factoring isn't debt financing, so it doesn't show up as a liability on your balance sheet.
That's huge, especially for early-stage companies or those who might not qualify for traditional loans.
Oh, yeah, no monthly loan payments, no interest accruing.
It's a great alternative to both debt and equity financing.
You're not diluting your ownership, and you're not saddling yourself with debt. It's a whole different approach to getting working capital.
Really is.
And then there's the added bonus of potentially outsourcing your accounts receivable management.
Yeah, let someone else chase down those late payments.
Right. The factor takes care of all the invoicing reminders, the follow-ups, the collections process.
Which frees up your team to focus on what they do best, building and selling great software.
And factoring companies, they specialize in this stuff. They're often more efficient at collecting, which can actually shorten your payment cycles.
Definitely can see an improvement in your DSO, days sales, outstanding.
And while it might be an indirect benefit, having that improved financial stability can also lead to better customer service.
How so?
Well, with more predictable cash flow, you can invest in better support teams, offer more flexible payment terms to your customers.
Right. You're in a stronger position to meet their needs.
Exactly. So ultimately, factoring can lead to greater stability and predictability across your entire business.
It helps with forecasting, budgeting, making those strategic decisions.
Okay, so we've talked about the benefits, but how does factoring stack up against other financing options for SaaS companies?
Good question. Let's compare it to some of the usual suspects.
Okay.
So first up, traditional bank loans. These usually require collateral And they've got pretty strict requirements based on your company's financial history and creditworthiness.
Tough to get.
Yeah, the process can be slow too. Factoring, on the other hand, is more focused on the creditworthiness of your customers, and it's generally much faster.
And no debt on the balance sheet, which is a big plus.
Right. Then you've got revenue-based financing, where you get capital in exchange for a percentage of your future revenue.
So your payments fluctuate with your revenue.
Which can be good, but it can also end up being more expensive than factoring, especially if you're growing quickly.
Whereas factoring gives you that immediate cash based on existing invoices, and the cost is more predictable with those factoring fees.
Exactly. And lastly, you've got venture capital, where you're giving up equity in your company in exchange for a large chunk of funding.
Yeah, that's a whole different ballgame.
The process is very demanding, it takes a lot of time, and you're losing some control of your company.
So factoring is really more of a short-term solution for immediate cash flow needs, not a long-term growth strategy.
Right. It's about bridging that gap, not about giving up ownership.
So to quickly recap the main differences, with factoring, the money comes from selling your accounts receivable.
Makes sense.
It often makes your balance sheet look better because you're converting receivables into cash without taking on debt. And eligibility depends mostly on your customer's creditworthiness.
Makes sense.
Funding can be pretty quick. There's no fixed repayment schedule like a loan. The cost is the factoring fee, and you keep full control of your company.
Makes sense.
The focus is really on short-term working capital and managing those accounts receivable.
Yep.
With traditional loans, you're adding debt to your balance sheet. Eligibility is all about your company's financials and collateral.
Right.
Funding takes longer. You've got fixed repayment terms with interest, and it's a more general-purpose financing tool.
Makes sense.
Revenue-based financing is tied to your future revenue. It doesn't directly add debt. Eligibility is based on your revenue and growth potential. The funding timeline can vary. Repayments are linked to your revenue, and it can be pricey for fast-growing companies.
Yep.
And the focus there is on growth capital.
Makes sense.
And with venture capital, you're giving up equity. Eligibility is about having a strong business model and high growth potential. The fundraising process is long and complex. There are no direct repayments, but you're losing ownership, and the focus is on long-term growth and scaling.
Makes sense.
So each option has its place.
Definitely.
Factoring is really unique in that it's this quick and flexible solution specifically for those cash flow gaps caused by outstanding invoices.
Yep. It fills a specific need.
So to sum it all up, accounts receivable factoring can be a super valuable tool for SaaS companies to overcome those cash flow hurdles that are just part of the subscription model.
Yeah.
You get that immediate cash flow, which is so important when you're dealing with the delay between delivering the service and getting paid.
And when you've got those big upfront customer acquisition costs,
it can really fuel your growth, cover your operating expenses, and you do it all without adding debt to your books.
Big advantage.
And the potential to outsource those accounts receivable tasks can be a real time saver.
Absolutely.
So as you're looking at your own outstanding invoices, think about how quickly converting those into cash could unlock new opportunities for your SaaS business.
Could be a game changer.
Carefully consider the benefits of having that cash on hand versus the fees involved.
Right. Do the math.
And make sure you explore the different types of factoring agreements out there to find the best fit for your company's goals.
Recourse versus non-recourse, notification versus non-notification, lots of options.
So could factoring be the key to unlocking your next stage of growth? It's definitely worth exploring.
Worth a look, for sure.
Thanks for joining us on this deep dive.
Thanks for having me.
And we'll see you next time.
See ya. Bye.